Hey guys, I want to do a quick video because I'm getting questions about this, not only from students, but also from business owners. Um, when do I consider something income for tax purposes? Now, with the new tax law, there are a lot more taxpayers that are considered cash basis taxpayers. So, under the new tax law in the US, if your annual gross receipts are less than $25 million, then you can be a cash basis taxpayer. Now, previously, that threshold was much, much lower. And if you had significant receivables, you would still have to be accrual basis. And if you had inventory, you had to be accrual basis. So they've really changed the rules a lot. But so that means that a lot more businesses are thinking about constructive receipt. Now, this is from section 451 2A. Okay. Um, and this defines when you consider something income. So constructive receipt, the general rule is that income, although not actually reduced to a taxpayer's possession, is constructively received by him in a taxable year during which it is credited to his account, set apart for him, or otherwise made available so that he may draw upon it at any time, or so that he could have drawn upon it during the taxable year if notice of intention to draw has been given. However, income is not constructively received if the taxpayer's control of its receipt is subject to limitation or restrictions. So let's think about this because there's a lot to unpack here. So, all right, so here's what you got to think about. Has it been credited to his account? Okay. So that means has it actually been deposited? So these are things like actual deposits into the account. Has it been set apart for him? Okay. And so this has been interpreted to mean things like if you have a check in your hand, then that is constructive receipt because the money has been set apart for you. Or if a client calls you up and said, hey, the check is waiting at my office, you just need to come pick it up. Or you know that there are funds set aside for you somewhere and you need to go get them, then that is constructive receipt. So the act of not picking up the money or not picking up the check or not putting the check in the bank, if you do any of those things, that does not mean that it is not income for you because you have access to the funds, right? It says, or otherwise made available so that he may draw upon it at any time, or so that he could have drawn upon it during the taxable year. So if you could get the money, but you choose not to, okay, that is still a constructive receipt. So let's look at some examples that I see quite a bit. So client mails a check to Barbara, which she receives via U.S. mail on January 4th. The memo on the check reads for December services. Is this income in December or January? Okay, so let's think about, so when did Barbara receive the check? The check was received in January. It doesn't matter when the services are for. If this is a cash basis taxpayer, it matters when she had constructive receipt. And in this case, it's January. Okay, let's look at a different example. So a client mails a check to Barbara, which she receives via U.S. mail on January 4th. The memo on the check reads for December services. The check is dated December 31st. Now, this is one where a lot of people think, well, if the check's dated December 31st, I have to pick up the income in the same year that the client picks up the expense. That is not true. I think some people get confused with the matching principle, which says that, that you must recognize expenses in the same year that the income. Okay, you're pulling something from financial into taxes. Don't do that. So in this case, even though the check is dated December 31st, when did Barbara receive the check? Because if she can't access the check, then she doesn't have constructive receipt. So in this case, this would be January. Okay, let's look at another example. Client mails a check to Barbara, which she receives via U.S. mail on December 31st, but she does not check her mail until January 2nd. The memo on the check reads for December services. The check is dated December 31st. The client emailed Barbara to let her know that the check would be there by December 31st. Okay, so she receives the check, but she does not get her mail, but she knows that it's in the mail. Okay, so basically, Barbara has decided, okay, I know there's a check there. Now, most people, right, there's a check there, you're going to run and get the check. Barbara decided not to do that. So she had access to the money on December 31st, right? She could have gone to the bank and put it in. I mean, I'll tell you, my business, I don't even go to the bank anymore. I deposit all my checks with my cell phone. So, and they instantly go into my account. So if you think about, okay, I could have walked out to the mailbox, gotten the check, instantly deposited it into my bank account. That's constructive receipt. That's December. Okay. So let's look at one more example. Okay. Because I know a lot of you are like, well, what about electronic payments, right? Because there's a lot going on with electronic payments. So, how about the client processes a payment to Barbara on December 28th, but in order for Barbara to receive the funds, she must go online and enter her banking information. She receives the email on December 28th, but does not enter her banking information until January 3rd. When is this income? Well, again, this is kind of similar to the last one, right? She could have gotten the money on December 28th, but she chose not to. And so because she chose not to does not mean that she can carry the income into the next year. And therefore, this is income for December. Okay. So I want you to kind of think about, here's a couple questions that you should ask if you're trying to make the determination, is this income in 1 year or the other, or 1 month or the other? Okay. So do you have the ability to access the funds? Right? So do you have a check in your hand? Do you have an email that says, hey, you've got these funds, click here to access them? Do you have the ability to get the money? Is the check ready for you? You just have to go pick it up. Now, I would argue, like, if I live in Connecticut and my client says, well, you can get the check, just drive to California. Okay, well, I really don't have access to the money, right? The check is sitting in California. I can't run to California and get it. Yeah, and I couldn't write that off as a business expense because the cost benefit wouldn't work out. So, in that case, I don't really have the ability to access the funds. Do you know that the funds are available? So there's a really interesting court case that I came upon when I was going through doing the research for this. And so in that case, the client had told, let's use Barbara in this example, had told Barbara that I'm going to pay you in 2 months. And then they ended up sending the check early. They didn't notify the taxpayer that they were sending the check early. And so the IRS tried to make the argument, well, it was sitting in her P.O. box. She just didn't check her P.O. box. And if she just would have checked it more often, she would have realized the check was there. The courts actually ruled in the taxpayer's favor because she was under the impression that the check was not coming, right? That she was going to get paid in 2 months. And so, for a lot of this stuff, like, documentation is really important. Like, let's say that you get a really big payment and you've got an email from a client that says, hey, the money's not going to come. Then you can use that to help prove that you did not willfully try to mislead the government about your income. And then the third thing is, are you making yourself unavailable? And so if you say, I'm not going to check my P.O. box from December 15th until January 2nd because there could be money in there, and I don't want to receive that money, the IRS is not going to go for that argument. If you go to the bank, or if you go to the P.O. box 3 times a week all year long, except the last 2 weeks in December, then, you're probably going to have an issue. Okay. So do you have the ability to access the funds? Do you know the funds are available, and are you making yourself unavailable intentionally? Okay, so those are the questions I want you to ask. And then based on those answers, I think it's a lot easier to determine whether or not you have constructive receipt. Okay, so listen, if you have more questions, I want to do more videos like this. And I want to do, especially with the tax law changes, I want to do more videos on tax, because tax is really my area of specialty in education. So I'll still do the financial accounting videos. I will still do the managerial accounting videos. But I'm going to be doing a lot more US based tax videos. So if you've got questions about taxes, managerial accounting, financial accounting, auditing, I'm not doing auditing videos. I'll tell you, I hated auditing in school, in practice. It's not my thing, but I'm totally a tax person. I love that stuff. So if you have more questions, you can send your questions to help@accountinginfocus.com. In the subject, type question, because I do get a ton of emails from you guys. I love when you reach out and tell me that you did well on your test. If this video has helped you in some way, leave a comment below or shoot me an email, because I just love when I hear back from you guys and you tell me how you're winning in your classes. So make sure that you do that. So I hope to hear from some of you soon. I can't wait to make more videos like this and answer your questions. So thanks so much, and I will see you soon.